we'll be taking up a problem from the exam kit on risk and uncertainty, the shifter's haulage. So let's jump right in. So the first part of the question is a general question. Explain maximax, maximin, and expected value criterion that are used to make decisions. So what was the maximax approach? It is adopted by an optimistic person or a risk taker. He selects the maximum of the maximum returns. That is how the name Maximax has come. And how do we do it? That is, the maximum returns of each decision option is selected. And from these returns, again, the maximum return is selected to arrive at the decision. Now coming to the maxi-min criterion, it is adopted by a pessimistic or a risk-averse person. So first you write the attitude of the person and then you write the method that is adopted. So what is the method? He selects the maximum of the minimum returns. That is, first the minimum returns of each decision is selected and then out of which the maximum return is selected. That is how we do maximin approach. And the last criterion that they have asked is the expected value approach. And what is the expected value? Expected value or EV, it's adopted by a risk-neutral person when the decision has to be repeated many times. It is just the long-run average. And what is the formula? EV is sigma px, where P is the probability and X is the outcome. And how do we make the final decision? We select the option with the highest EV. So that's what is written last. The decision with the highest EV is selected. Now we will go to the question extracts to tackle the second part of the question. Prepare a profit table. Profit table is nothing but a payoff table showing the 6 possible profit figures per period. Shifter's haulage is considering changing the vans it uses to transport crates for customers. New vans come in 3 sizes. So you have the small van, the medium van, and the large van. So they are unsure as to what to buy. The capacity is 100 crates for the small van, 150 for the medium, and 200 crates for the large van. So this is the decision that we have to take. What is the decision? Whether we have to buy a small van, medium van, or a large van. Now coming to the uncertainty part. The demand for crates varies and is either 120 or 190 crates. So we are unsure as to whether the demand will be 120 crates or 190 crates. So what is that? That is nothing but the uncertainty. With the probability of the higher demand. Probability of the higher demand means probability of 190 crates being 0.6. So what is the probability for 120 crates? Since the total of the probability should add up to 1. If 0.6 is for 190 crates, then obviously the demand for 120 crates should be 0.4. Only then will the total of probabilities be equal to 1. Now, whenever we construct a payoff table, we will be plotting the decision as the column headings and the uncertainty as the row headings. So what is the decision? Whether to buy small van, medium van, or large van. And what is the uncertainty? The uncertainty is the demand for crates, whether it is 120 or 190 crates. So let's write the decision and the uncertainty as the column headings and the row headings. So the decision option is whether to buy small van with a capacity of 100 crates or to buy a medium van with a capacity of 150 crates or a large van with a capacity of 200 crates. And as for the demand is concerned, the demand can either be 120 crates or 190 crates. So the skeleton of the payoff table is complete. Now we know that the probability that the demand is 190 crates is 0.6. So we will make a note of that too. So for 120 crates, it is 0.4 because both should add up to 1. Now, before we go deeper into the problem, what is our aim? Our aim is to fill up the profit table or to find out the profit that we earn under various situations. So I will show you the working note that we will be preparing to arrive at the profit figure. So this is the working note where we have the sales, and that is indicated in green, which means that it is an income, and you have to reduce the variable cost to arrive at the profit. So that is why I've indicated variable cost in red, because variable cost is an expense. Next comes the variable cost adjustment, which is an income. So we will just read the question extracts to get an idea as to what this variable cost adjustment is. So the selling price per crate is $10. So that will definitely come in sales. And the variable cost is $4 per crate. So that will come under variable cost. Now listen to the next sentence very carefully. If capacity of the van is greater than the demand for the crates, then variable cost will be lower by 10% as vans will be partly empty. What does this mean? Suppose this is the van and the capacity of the van is say 100 crates. But what have they said? The demand is less than the capacity, which means that the van is not fully occupied. So the van is partly empty, which means that the variable cost of $4 per crate has to be adjusted. It is not $4 per crate anymore. Maybe you would have a savings on the fuel cost to a certain extent because you don't need to distribute to many places. So basically, we will have to make an adjustment for this variable cost of $4. It is an amount less than $4. So whenever you are trying to reduce the variable cost, it obviously is an income, right? That is why I have mentioned variable cost adjustment as an income and indicated it in green. And what is the amount that you have to adjust? 10%. So basically you will have a 10% variable cost adjustment when the van is partly empty. Now going back to the question, if the demand for crates is greater than the capacity of vans, just the reverse. That is, already the van is full and the demand is again increasing, which means that more and more customers are again coming to you, which means that you will have to say no to certain customers, right? So if you turn away the customers, then they have said, then the customers will be turned away, whereby goodwill of $100 would be charged against the profits per period. Your goodwill will reduce because you are telling no to certain customers. And they are telling you the goodwill has to be adjusted against the profit. A reduction in goodwill, that's actually an expense because our goodwill, our reputation is getting affected. So that is $100 that they have mentioned. So goodwill adjustment, I have indicated it in red because it is an expense. And finally, the last item to be adjusted to arrive at the profit is depreciation. Depreciation would be $200 per period for the small van, $300 for the medium, and $400 for the large van. And finally, when you adjust all these amounts, you get the profit. Now we will start off with the profit table. So what is situation one? Situation one is when we have a small van with a capacity of 100 crates and the demand is 120 crates. So the demand is higher than the capacity. So we will be able to sell the entire quantity of 100 crates. So 100 crates sold and the selling price is $10 per crate. So the sales will be 10 into 100 or $1,000. Coming to variable cost is $4 per crate and we are selling 100 crates. So variable cost is 4 into 100 or $400. And since it's an expense, I have written that in bracket. Now, in this particular case, the capacity of the van is less than the demand. So capacity of the van is less than the demand, which means that we will have to do a goodwill adjustment. And what is a goodwill amount? $100. So against goodwill, which is an expense, I will be writing $100, and variable cost adjustment will not come here because that is when the capacity is greater than the demand. Here, the capacity is less than the demand. Always remember that variable cost adjustment and goodwill cannot come together. Variable cost adjustment is when the capacity is greater than the demand, and goodwill comes when the demand is greater than the capacity. So in this particular case, the demand is greater than the capacity and hence we have the goodwill adjustment only. Now, what is the depreciation for the small van? It is $200. So we adjust To arrive at the final profit of $300, we make a note of the profit in the profit table as $300. Now coming to the second situation. What is the second situation? We have a small van with a capacity of 100 crates and the demand is 190 crates. So all the figures remain the same. We will be able to sell the entire quantity of 100 crates because the demand is very high and the variable cost for 100 crates is again $400, and we will have to make a goodwill adjustment because the demand is greater than the capacity, which means that we will have to turn away certain customers and therefore the goodwill adjustment is $100. And finally, the depreciation for the small van is $200. So basically, it is a very same figure that comes in the second slot also as $300. Now moving to the third situation. What is the third situation? We have a medium van with a capacity of 150 crates and the demand is only 120 crates, which means that the demand is less than our capacity. So this case, okay, demand is less than the capacity, which means that we will need to have a variable cost adjustment. So we will start off with the sales. So if the capacity is 150 crates and the demand is only 120 crates, how many crates can we sell? We can sell crates only to the extent of the demand. So the demand is only 120 crates. So we will be able to sell also only 120 crates. So what is the sales figure? It is $10, that's the selling price, multiplied by 120 crates, which is the demand. So 10 into 120, $1,200 is the sales amount. And coming to variable cost per unit, it is $4, and we are able to sell 120 crates. So it's 4 into 120 or $480. And here the capacity is greater than the demand, which means that we will have to make a variable cost adjustment of 10%. That is, variable cost amount is not $480. It is an amount less than 480. Less by how much amount? Less by 10%. So we will make a variable cost adjustment, 10% of $480. That's 48. So that is why I've indicated that in green. Since it is a reduction in expense, it comes as a positive figure or it comes as an income. Now here you wouldn't have a goodwill adjustment. And what is the depreciation of the medium van? Medium van depreciation is $300. So we write that to arrive at the profit as $468. And we make note of it in the profit table. Now, situation 4 is when we have the medium van with a capacity of 150 crates and the demand is 190 crates. The demand is greater than the capacity. Demand is greater than the capacity, in which case we will have the goodwill. So let's start off with the sales. Since the demand is very high, we will be able to sell the entire quantity of 150 crates. So what is the sales? It is $10, that is the selling price per crate, multiplied by 150 crates, which we are able to sell. So 10 into 150, $1,500 is the sales value. Coming to variable cost, it's $4 multiplied by 150 crates. So it is $600. Variable cost adjustment will not happen here. It is a goodwill adjustment that happens here. So it amounts to $100. And what is the depreciation of the medium van? It is $300. So we write the depreciation amount to arrive at the final profit of $500. We make a note of it in the payoff table. Now coming to situation 5, where we have the large van with a capacity of 200 crates and the demand is only 120 crates. The demand is less than the capacity. The demand is less than the capacity, which means that we will have a variable cost adjustment. So we will start off with the sales. So we have a capacity of 200 crates, but unfortunately, the demand is only 120 crates. So we will be able to sell only a maximum of 120 crates because the demand is only 120 crates. So what is the sales value? Per crate, it's $10 and we are able to sell 120 crates. So 10 into 120 or 1,200 is the sales value. Coming to variable cost, it's $4 per unit multiplied by the units sold, 120. So it is negative $480. So we have a variable cost adjustment here at the rate of 10%. So it is 480 into 10% or $48. and we do not have goodwill here. Depreciation of the large van is $400. We make note of it to arrive at the final profit of $368. Now coming to situation 6. Situation 6 is where we have the large van with a capacity of 200 crates and the demand is only 190 crates. The demand is less than the capacity. So that is here. So again, we have a variable cost adjustment. And what is the quantity that we are able to sell? We are able to sell only 190 crates because our sales is always restricted to the demand of the crates. So the sales value will be selling price per crate $10 and the sales in units 190 crates. So it is $1,900. Now coming to variable cost, it's $4 per crate. So it is 4 into 190, giving an amount of $760. And we have a variable cost adjustment at the rate of 10%. So it is 760 into 10%, giving an amount of $76. We do not have goodwill here. And the depreciation of the large van is $400. We indicate that in the working note to arrive at the final profit of $816. We make a note of it in the profit table. Our profit table is complete. Now coming back to the question, Part C asks you, using your profit table from B above, discuss which type of van assets should buy, taking into consideration the possible risk attitudes of the manager. So initially they had asked you to explain about Maximax, Maximin, and the expected value approach. So we will find out based on these, what is the decision. So let's first start off with Maximax criterion. So Maximax is maximum out of the maximum profit. So first we will find out the maximum profit of each of the decisions. So the maximum profit, if we decide to buy the small van, is $300. For the medium van, it is $500. And for the large van, it is $816. Out of which we have to select the maximum. So among the maximum, 816 is the highest. So the decision will be to buy the large van. Now coming to the Maxi-Min criterion. So in this case, we have to first select the minimum profits of each decision. So the minimum profit, if we decide to buy the small van, is $300. The minimum profit for the medium van is $468. And the minimum profit for the large van is $368. Out of the minimum profit, we have to select the maximum. So out of this, the maximum is $468. So the decision will be to buy the medium van. So that was Maxi-Max and Maxi-Min criterion. And now coming to the last approach, that is the expected value approach. For expected value method, we need the probability of each uncertainty. It was 0.4 and 0.6. This information we had picked up from the question initially. Now the expected value is given by the formula sigma px, where p is the probability and x is the outcome. So what is the first decision option? The first decision option is to buy a small van. So what is the expected value? Since the profit in any kind of uncertainty is $300, we don't actually need to apply the formula of sigma px. The answer or the expected value is $300. Now coming to the next decision option of buying the medium van. So the formula is sigma px, or probability multiplied by outcome. Since it is sigma, we have to add. So probability is 0.4 multiplied by outcome of 468 plus probability of 0.6 multiplied by the outcome of $500. So EV is $487. Now coming to the last decision option, that is buying the large van. So again, sigma px, it's probability 0.4 multiplied by outcome 368 plus probability of 0.6 multiplied by outcome of $816. So we get the answer as $637. Now all that we have to do is pick the highest EV. The highest EV is $637. So the decision is to buy the large van. So let's just summarize our findings. If it is a Maxi-Max, we have to buy the large van. If it is a Maxi-Min, we have to buy the medium van. And if it's the expected value approach, we have to buy the large van. So what have they asked in the question? Discuss which type of van SH should buy, taking into consideration the risk attitude of the managers. Now, what is the risk attitude of the managers? Let's revisit the question once again to identify what is the risk attitude of the manager. So here we have the question extracts. SH is considering changing some of the vans it uses to transport crates for customers. So the intention is to continue the business for a long period, which means that we could adopt expected value approach because expected value is used when the decision is repeated many times. So the question indicates that the decision will be repeated many times. Now coming to the next sentence, SH has in the past been very aggressive in its decision making. Aggressive means they are risk takers or maximax approach, pressing ahead with rapid growth strategies. However, its managers have recently grown more cautious as the business has become more competitive. Cautious. Cautious means they will immediately adopt the maxi-min approach. So based on the risk attitude of the manager, we cannot adopt maxi-max because now they are no more aggressive. They are cautious, which means that we have to adopt the maxi-min approach. So the final answer will be, as SH is considering replacing a number of vans, EV could be adopted, not being a one-off decision. That is, the decision will be repeated many times. That is, the intention is to continue the business in the future. So we could adopt EV. However, it's also given that managers are cautious and hence maxi-min could be adopted. So either it's EV or it is maxi-min. The final decision lies with the manager. So it is their option whether they want to adopt the maxi-min or the expected value approach. If EV is adopted by the large van, if maxi-min is adopted by the medium van. So we are finally done with the question. If you have found this video useful, do support the channel by clicking the subscribe and the like button. And if you would like to receive notifications for similar videos, do click the bell icon too. So thank you all and see you in the next video.